Good afternoon, ladies and gentlemen. Thank you for participating in Bullion Management Group's Currency Wars and Capital Markets, No Escape, live webinar with guest speaker Jim Rickards, author of the national bestseller Currency Wars, The Making of the Next Global Crisis. I would now like to welcome our host, Nick Barishev, President and CEO of Bullion Management Group Incorporated. Please begin, Mr. Barishev.
Hello, everyone. My name is Nick Barishev. I'm President and CEO of Bullion Management Group. I'd like to thank you for participating in today's webinar. I know as summer approaches, our calendars tend to fill up quickly. Today's event will begin with a presentation by our guest, Jim Rickards, lasting about 45 minutes. Then we will open up with our question and answer session, during which Jim will personally answer questions. You may submit questions anytime during the presentation through the Q&A feature on your screen. It's my privilege to introduce our guest speaker for today, Jim Rickards. He is the author of the national bestseller, Currency Wars, The Making of the Next Global Crisis. Jim is a partner in JAC Capital Advisors, a New York-based hedge fund. He has been interviewed by the Wall Street Journal and has appeared on CNN, BBC, NPR, CNBC, Fox, and Bloomberg. He is an op-ed contributor to the Financial Times, New York Times, and the Washington Post. He is a counselor and investment advisor and has held senior positions at Citibank, Long-Term Capital Management, and Caxton Associates. In addition, Jim is an advisor on capital markets to the Director of National Intelligence. Jim holds an LLM in taxation from the NYU School of Law, a JD from the University of Pennsylvania Law School, an MA in economics from SAIS, and a BA from Johns Hopkins. I'm delighted to introduce Jim Rickards.
Thank you, Nick. Thank you. It's very nice to be with you and to join the webinar audience for today's presentation. Our topic is Currency Wars and Capital Markets, No Escape, and that's a reference to the fact that public policy is being conducted by central banks around the world has led the world monetary system, the international monetary system, into a place where there does not seem to be any good way out. There are a number of potential ways out, including hyperinflation or a deflationary collapse or some kind of unpredictable dynamic collapse, loss of confidence in paper currencies. But no matter how you look at it, as I say, there seem to be no really good ways out. But we'll talk about that a little more specifically as we jump in now. I'd like to start with the definition of a currency war. The topic is currency wars, and my book is Currency Wars, The Making of the Next Global Crisis. Well, what is a currency war? A currency war, in its simplest form, is just the devaluation of one country's currency against that of others in order to gain trade advantage and to help your economy. So the simplest way to explain it is imagine you had 4 stores in a small town and they all sold more or less the same thing, and one of them had a half-off sale. Well, obviously everyone would go to the place that was having the half-off sale. It's no different in currencies. When you look at the global market for, let's say, jet aircraft, you've got a few manufacturers, large ones. You've got Boeing in the United States. You've got Airbus in Europe. You've got Embraer in Brazil, and a few others. And let's say you're a country that needs aircraft for your airline, but you don't make them. You don't have an indigenous aircraft industry. Well, you're going to go shopping. You're going to look at the different manufacturers, and you're going to look for the best price. And if we cheapen the dollar, this could make our aircraft look relatively attractive to a buyer in, say, Thailand or Indonesia. So that's the basic idea, is to make the Boeing aircraft look a little bit cheaper than the Airbus equivalent and sell some more aircraft, create exports, improve the U.S. economy, and create jobs. And everyone says, well, gee, what's not to like about that? That sounds like a pretty good deal. The problem is it never quite works out that way. It's never that simple. I mean, if the U.S. could operate in a vacuum, if we were the only actor, there might be some short-run advantage. But in fact, that's not what happens. What happens is other countries retaliate. They cheapen their currency as well, or they put on capital controls, or they put on excise taxes on imported goods, which is the same as cheapening your currency. One way or another, countries fight back, and all advantage is temporary. So the problem with currency wars is that they're irresistible to politicians and policymakers because it sounds like a free lunch. You can cheapen your currency and sell more of your goods, help exports and create jobs. But in fact, it just unleashes a process of competitive devaluations, which usually ends up in either a restriction of world trade, which is what happened in the 30s, or extreme inflation, which is what happened in the 1970s. And we'll look at both of those cases. So let's go back in history a little bit and look at some of the earlier currency wars I've identified, think about their dynamics, and then we'll kind of relate that to the current situation. I have what I describe as Currency War I, which I date from 1921 to 1936. Obviously, some overlap there with the Great Depression, which is conventionally dated from about 1929 to 1940. But this sequence of Currency War I starts earlier, really in 1921, 1922 in Germany with the Weimar Republic hyperinflation that people are quite familiar with. Here was a deliberate effort by the Central Bank of Germany to destroy its currency for various purposes. They had to do with sort of hurting their economy, gaining sympathy from the United States in terms of the onerous reparations that had been imposed on Germany at the end of World War I from Britain and France. But whatever the reasons, it was ruinous, and very quickly, we've all heard the stories of how it took $1 trillion Reichsmarks to buy one loaf of bread. But in fact, there came a time when the currency was completely worthless and it had no value at all, and it was just swept down the sewers as a form of litter. It was really just scrap paper at that point, and it ceased to function as a currency. But what's less well known is that immediately thereafter, Germany had to reconstitute its currency, and they went back to a gold-backed mark, and this worked very well. And from 1924 to 1929, Germany had the fastest-growing major industrial economy in the world. So it does show that there's life after a currency collapse. You just need a currency that's based on gold or something that inspires confidence as opposed to mere paper currency. So as ruinous as the Weimar hyperinflation is, the aftermath was actually encouraging. It showed that you can go back to a gold-backed currency and have very good growth. Well, that was Germany's turn in 1921. By 1925, it was France's turn. Major countries in the world were going back to the gold standard, which they had abandoned in 1914 at the outbreak of World War I. From about 1870 to 1914, major countries in the world were on a gold standard, and their individual currencies were linked to gold at a fixed rate, which meant that indirectly the currencies were linked to each other at a fixed rate because they could all be converted into gold at some ratio, and it wasn't difficult to figure out the cross rates between the different currencies. That was a period of low inflation, high growth, technological innovation. It was really the first period of globalization and a very strong period, as I say, of innovation and growth with low inflation, even deflation of the good kind around the world. Countries abandoned that in 1914 to print money to fight World War I, but by 1925 they were ready to go back to some kind of international gold standard. But it raised the question, well, at what exchange rate would you go back? At what rate from your currency, whether it was the French franc or the Belgian franc or pound sterling or U.S. dollars for that matter, would you go back to gold? And what France decided to do, France and Belgium, was to devalue their currencies relative to gold. They were not going to go back at the same exchange rate they had in 1914. They were going to cheapen their currencies, which they did, and this led to a period of inflation and currency collapse in France, but they stabilized after that. Once they got back to gold, even at this new rate, things stabilized in France. So they were the second ones to devalue their currency. A lot of people have maybe seen the Woody Allen movie Midnight in Paris. It portrays U.S. expatriates, artists and writers and others living a very lavish lifestyle in Paris during the 1920s. Well, that was true because the French franc had devalued so much that if you had any amount of dollars at all, you could live a very good lifestyle in France, and that's why a lot of those expatriates went there. So that was kind of a living example of what happens when one currency collapses. People with a stronger currency can come in and, as I say, have a fairly high standard of living. Well, go ahead to 1931. So now we've seen Germany destroy its currency in 1921, France and Belgium devalue in 1925. By 1931, it was England's turn. They had very disadvantageous terms of trade. They were suffering from deflation, high unemployment. This is because they made the mistake of going back to gold at the pre-World War I price. The problem was that during World War I, England had vastly expanded its money supply in order to fight the war, and when they wanted to go back to gold, in order to go back, where you had doubled the money supply, you either had to double the price of gold to reestablish that paper-to-gold ratio, or you had to cut the money supply in half to do the same thing, to get back to the same ratio. It would have made a lot more sense to just raise the price of gold, admit the fact that you had cheapened your currency, just have a higher price for gold, but that's not what England did. They did, in fact, decrease the money supply, and that was highly deflationary and destructive of the UK economy. That was a major blunder. So by 1931, they couldn't. Their currency was far too strong. They went off the gold standard, devalued their currency relative to other currencies, and then that left the United States as sort of the last man standing. That was the acute phase of the Great Depression from the U.S. perspective, 1931, 1932. Finally, by 1933, after suffering a bank run in the United States, FDR devalued the dollar, took the dollar from $20 an ounce to $35 an ounce. So that was actually a 75% increase in the price of gold and a correlative devaluation of the dollar. And then in 1936, finally, there was another devaluation of pounds and francs. So what you had all along were these competitive devaluations: 1921 Germany, 1925 France, 1931 England, 1933 the United States, and 1936 England and France again. All the world got out of it was collapsing world trade, Great Depression, declining industrial production. Absolutely nothing good came out of it. No one really benefited from these rounds of so-called beggar-thy-neighbor devaluations, but that's how it played out. The world really had to learn the hard way that devaluing your currency was not a way to grow your way out of a depression. Come forward now to what I call Currency War II. The next slide, this I date from 1967 to 1987. Here we had a slightly different dynamic with an equally sort of disastrous result, which was that by the late 1960s, the United States was trying to pursue the so-called guns and butter policy of Lyndon Johnson. Guns referred to spending on the Vietnam War, and butter referred to the Great Society programs of benefits and welfare and entitlements. And Lyndon Johnson thought America was a rich country that could afford both. Well, we were a rich country, but we couldn't afford both. This was the beginning of the period of the twin deficits, the budget deficit and the trade deficit. Finally, this really kicked off in 1967 when England again broke with Bretton Woods. Now, Bretton Woods had launched in 1944. It was a little different than a pure gold standard. It was a kind of gold exchange standard where the dollar was pegged to gold and everyone else was pegged to the dollar at a fixed exchange rate. So technically what England did was devalue sterling against the dollar, but the effect was the same. It was the same as breaking with gold, and they cheapened their currency to help with their balance of payments. Well, this then put pressure on the dollar. The same sequence followed as happened in 1931 and 1933. This time it took a couple more years, but by 1971, there was sort of a run on Fort Knox. At this time, the U.S. trading partners, if they accumulated dollars through a trade surplus with the United States, they could actually take the dollars and cash them in for gold, and they did. In 1950, the United States had 20,000 tons of gold. By 1970, we were down to 9,000 tons. We lost 11,000 tons of gold in that 20-year period. And you say, well, where did the gold go? It went mostly to our trading partners, 3,000 tons to Germany, 2,000 tons to France, 2,000 tons to Italy, some to the UK, some to Japan and elsewhere. But Nixon could see it was just a matter of time before we would run out of gold, and rather than adopt economic policies that might have made the U.S. more competitive, he just devalued the dollar and went off the gold standard in August 1971. Ever since then, the world's been on really a dollar standard. We had the gold standard I mentioned from 1870 to 1914. We had a kind of gold standard, not a very well thought out one, from 1925 to the beginning of World War II. We had the Bretton Woods gold standard from 1944 to 1971. But beginning in 1971 and ever since, we've really been on a dollar standard. That's what the world looks to. And what Nixon said to our trading partners, in effect, was, hey, if you earn dollars exporting goods to us, you can take your dollars, you can buy our treasury bonds, you can buy our companies, you can invest in treasury bills, but you can no longer get gold. And indeed, the U.S. has held on to all of its gold ever since. What came out of that? Well, we had one of the worst periods of economic performance in U.S. history other than the Great Depression. We had three significant recessions back to back to back in 1974, 1979, and 1980. Between 1977 and 1981, the value of the dollar, just in that 5-year period, was cut in half. We had 50%, 50%, inflation cumulatively over that period of time. And, of course, the price of gold, as well known, went from $35 an ounce to briefly $800 an ounce, which was a virtual 95% collapse of the dollar. That probably would have meant the end of the dollar, somewhere along in that time sequence, except along came Paul Volcker and Ronald Reagan, and they restored confidence in the dollar with the King dollar policy of low taxes and high interest rates. Paul Volcker raised interest rates as high as he needed to snuff out inflation and also make the U.S. an attractive target for foreign investment. If you can earn 15, 20% interest rates in dollars, you're probably going to take your dollars and invest here. So that helped, and then Reagan's tax cuts and deregulation helped as well and got the economy off to 2 good decades back-to-back in the 1980s and the 1990s, with only one brief and fairly mild recession in 1990, 1991. And so we've been on that dollar standard, but that was really because of Paul Volcker and Ronald Reagan. And that sort of brings us up to the current day and what I call the beginning of Currency War III. And once again, the United States, as happened in the 1930s and has happened in the 1970s, is out to weaken the exchange value of the dollar. This is the explicit policy of President Obama and Secretary Geithner and Fed Chairman Bernanke, the White House, the Treasury, and the Fed together. And this was really outlined in January 2010 in President Obama's State of the Union address when he announced what he called the National Export Initiative and said it is the policy of the United States to double exports in 5 years. Well, that sounds good, but you have to ask yourself, how are you going to double exports in 5 years? We're not going to get twice as smart or twice as productive, and there won't be twice as many of us. The only way to double exports to that extent is to cheapen the value of your currency by as much as 50%. Now, the president didn't say it in so many words, but that was clearly the implication of the National Export Initiative. So once again, the U.S. had set out on this really ruinous path of competitive devaluation. So we're in Currency War III. The last two currency wars, Currency War I lasted for 15 years. Currency War II lasted for 20 years. We've just started Currency War III, so my expectation is that this will last for some extended period of time, whether it's 5 years or 10 years or 15 years remains to be seen. But once these things start, they take on a life of their own, and they're not over quickly. So again, we have the dynamics of currency wars where they're very attractive to politicians and policymakers because it looks like a free lunch in terms of increased exports and jobs. But in fact, it never works out because of retaliation, tit-for-tat currency devaluations, excise taxes, duties, and currency wars very quickly turn into trade wars or countries impose capital control. So you just end up with a very dysfunctional global economy in that respect. I'd like to talk a little bit about kind of the fiscal and monetary policy origins of currency war, what really drives them, and go to the slide which shows our simple 4-part formula for GDP. GDP, of course, is gross domestic product. That's the sum of all the goods and services produced in the United States. And it has 4 parts. C stands for consumption, I stands for investment, G stands for government spending, and X minus M is exports minus imports, or what are called net exports. And that's it. Your consumption, your investment, your government spending, and your net exports are what make up the GDP. And when you look at those parts, think of it as a four-cylinder car and ask yourself how the engine's running. Consumption is very weak. It's kind of flat. It's not growing very much. It's because consumers are overburdened with debt, whether it's upside-down mortgages where the mortgage is greater than the value of the house, so the homeowner has negative equity, 401ks getting wiped out, car loans, consumer loans, credit cards, student loans, all the indebtedness of the consumer is weighing on consumer spending. So that's not doing very much to drive the economy. Investment, likewise, is partly a function of consumption. You're not going to build a plant to produce a lot of goods unless someone's there to buy the goods. And so if the consumer is weak, then investment would be weak as well, unless somehow you expect the consumer to come roaring back next year. You might build a plant today, but I don't know anyone who has that expectation. It looks like we're kind of stuck in a Japanese-style funk that may go on for a long period of time. And so neither consumption nor investment are contributing very much to GDP. That brings us to government spending. Now, government spending was a big driver of what happened in 2009 and 2010. That's what got us through what otherwise clearly would have been a much more severe recession, even depression, based on what had happened in 2008. But that ran out of steam. The combination of political pushback, the Tea Party, the Republicans taking the House of Representatives in 2010, all these things have combined to really put a lid on increases in government spending. Bear in mind, the government spending is still huge. Our budget deficits are running about $1.4 trillion a year, but that's not what drives GDP. What drives it is the increase in the deficit. So we still have $1.4 trillion a year of new debt, but it's not an increase over the year before, and so it doesn't really increase GDP. So consumption's not contributing, investment's not contributing, government spending's not contributing. What's left? Well, what's left is net exports, and the way to gin up net exports, as we described, is to cheapen your currency. So this is really the economic argument behind the currency wars and why the government's trying to cheapen the currency, because they believe it's the only thing we've got going for us in terms of economic growth, and this is something the White House desperately wants in order, obviously, to get the economy moving and indirectly help the president's re-election chances. So that's one driver. I'd like to jump ahead now to talk about monetary policy a little bit. And here the issue is what's called the quantity theory of money, and we show it in the next slide where we have a simple equation or identity, MV equals PY. And I'll explain those terms. M is the money supply. That's the money that's printed by the Fed. V is something called velocity, which is just the turnover of money. So I like to say if I, go out to dinner and pay the dinner bill, and the waitress takes her tip and takes a taxi home, and the taxi driver fills his cab up with gas, that hypothetical dollar has a velocity of 3 because it supported $3 of goods and services, the restaurant bill, the taxi ride, and the gasoline. But if I take my money and put it in the bank, that has velocity of 0 because I haven't spent it at all. And so the Fed can increase money supply as much as they want, but if velocity is going down, that's a problem. Those two things together, money supply times velocity, equals nominal GDP. Nominal is just the actual dollar value of goods and services. And that has two parts. Y is real GDP, and P is the price index. So you take the real GDP and increase it or decrease it by inflation or deflation, and that gives you your nominal GDP. So we have this very simple equation, and if you think the velocity is constant and you want to get the nominal GDP increased, all you have to do is increase the money supply. If you look at the next slide, you see that that's exactly what the Fed has done. That expansion of the U.S. money supply, chugs along at a considerable rate of increase, but somewhat stable until 2009, and then it takes off like a Roman candle, shoots straight up to about $1.6 trillion. Then it goes sideways a little bit for a while. That's really, that first leg up is QE1. The sideways part is the time period between the end of QE1 and the beginning of QE2. And that second leg that goes straight up, again, like another Roman candle, that's QE2. And now you'll see it's going sideways again. Well, that's because QE2 was over at the end of June 2011. So here you very graphically see QE1 and QE2 and the impact of the increased money supply. This is the Fed printing money. Well, if you go back to the slide before and you say, gee, if you're going to increase all that money, then doesn't that mean the economy is really going to take off? And the answer is you have to go ahead to the next slide for velocity. And what you'll see there is the velocity of money is sinking like a stone. In other words, it doesn't do you any good to increase the money supply if velocity is going down. I like to say that 3 trillion times 0 is 0. In other words, you're not going to get any economic growth with zero velocity. People have got to be willing to get out there and lend and spend the money. And so this is really the dilemma the Fed is facing. They can increase the money supply as much as they want, but they can't really drive the economy unless people are willing to spend it, and also whether the money supply increases even more as a result of Fed actions to encourage that through the banking system. Go to the next slide. I call it monetary math made easy. I have two very simple equations. I think this is sort of third-grade math, but 1 plus 4 equals 5, and 4 plus 1 equals 5. But the point here is take the first term to be inflation and take the second term to be the increase in real GDP. And you take inflation plus real GDP, that equals nominal GDP. Well, the first equation, 1 plus 4 is 5. This is Fed nirvana. This would be 1% inflation, 4% real growth, combined to give you 5% nominal growth, which is a very strong rate of growth and would go a long way to helping to pay off the debt because the debt is in nominal terms. And the Fed wouldn't mind that, but the Fed will take the 4 plus 1. In other words, the Fed's focus right now is on the 5. They've got to get nominal GDP up because the debt is nominal, and if you don't have nominal GDP, you're not going to have the money to pay off the nominal debt. The Fed would prefer the 1 plus 4, but they'll take the 4 plus 1 if that's what it takes. In other words, 4% inflation and 1% real growth would give you 5% nominal growth, and the Fed would accept that. So this is a very simple illustration of the fact that with the Fed targeting nominal GDP, they're willing to tolerate a much higher rate of inflation if that's what it takes. My problem, in going to the next slide, is, and I've got an illustration here of a thermostat and a nuclear reactor. And I like to say that the Fed thinks they're playing with a thermostat, but they're actually playing with a nuclear reactor. They just don't know it. When your house is too cool, you can dial up the thermostat and make it warmer. If your house is too warm, you can dial the thermostat down and make it a little cooler. But that's a very linear progression. Over to the nuclear power plant where you have control rods and fuel rods and neutron generators, well, you can dial up a nuclear power plant or dial it down also, but if you get it wrong, the house is not just going to be too warm. You're going to have a catastrophic meltdown. And what troubles me is the Fed thinks they're playing with a thermostat, but actually playing with a nuclear reactor by trying to manipulate expectations and dial up the money supply and change expectations about velocity and change really behavior, that they risk doing something that triggers a catastrophic run on the dollar. So, again, this is just a very simple way to illustrate the difference between linear systems and critical state dynamic systems, and some of the dangers I think are not appreciated by the Fed. I'll go through the next couple of slides quickly just to illustrate a few points. We have our bell curve, which is a normal distribution of risk. This is what's called a degree distribution, where the vertical axis, or what's often called the y-axis, shows the frequency of the event, and then the x-axis, the horizontal axis, shows the severity of the event. And if you look at just the right-hand side of the curve, it's what you would expect, which is that the more severe events happen less frequently. But the question is, what is the shape of the curve? Here we're showing a bell curve, which is a normal distribution. And one of the characteristics of the bell curve is the really extreme events drop off very quickly. That line gets down to the horizontal axis, to the x-axis, and shows you that certain extreme events are practically impossible, or they're given probabilities of happening once since the Ice Age or once since the beginning of the planet Earth, but very, very, very extreme events that for all intents and purposes are impossible. And yet we actually see events like this all the time, every 3, 4, 5 years in our capital markets. But financial modelers and people on Wall Street cling to this normal distribution when, in fact, empirics say that it's not a normal distribution at all. And if you go to the next slide, you'll see something called a power curve. And this is a much better fit to what's actually observed. When you take extreme events and losses and big up days and big down days in the stock market, and you plot the severity relative to the frequency, this power curve is actually what you get. And if you notice on the right-hand side of the curve down along the x-axis, that does not touch the x-axis. In other words, it sits above it. This is the famous fat tail, which means that those really extreme events out on the right-hand side of the graph happen with a higher frequency than the bell curve would suggest. And, of course, that's what we actually see in the real world. The problem is that this is not just an academic debate between two degree distributions or curves of two different shapes. These curves represent completely different dynamics and completely different phenomena, and that's really what the Fed doesn't understand. As I say, empirics aside, we're dealing with completely different types of systems. If you look at the next couple slides, I'll go through them quickly. The volatility index, you see off on the right-hand side, the spikes. This is all the extreme activity we saw around 2008. The next one, credit default swaps, again, the spreads blowing out. The one after that, we see the NASDAQ stock market bubble peaking and then crashing in 2000 with the crash and the blow-up of the dot-com bubble. When you actually take these types of events that I've just illustrated and put them on a curve, you get this power curve, and the next slide compares the two. And again, the thing I want to really focus on is off on the right-hand side of the curve, where the power curve says the probability of those extreme events is 0 because the curve is touching the x-axis. The bell curve says the probability is 0 because the curve is touching the x-axis. As you see on the power curve, the probability is not 0. It's significantly higher, and that's what we're actually getting in capital markets. The next slide shows the same power curve on a logarithmic plot, and the point here is that it's a straight line at an angle. The angle can vary, and that's really, it varies based on the type of phenomena. But if you look along the x-axis, you'll see that as your severity of the event is increasing as a function of the scale of the system, it's increasing exponentially. In other words, it's not doubling and tripling and quadrupling. It's going up by factors of 10, 100, 1,000, 10,000, 100,000. And this is really what's going on in capital markets. As we increase the scale and complexity of our markets, we're not, Wall Street would have you believe that risk increases very little because you have long, short, long, short, long, short. In other words, you have offsetting positions. But as we know, the risk is not in the net position. It's in the gross position. And when you look at the gross position and consider that risk is an exponential function of scale, what you find is that we are enormously increasing risk in ways that are not very well understood, and I don't think appreciated by the Fed at all. And this is really what troubles me, is that the Fed thinks they can just print money and solve all the problems, but they don't understand, as I say, they're playing with this nuclear reactor, increasing the scale of the financial system and engaging in an exponential increase in risk, which will end catastrophically. The next slide, I illustrate the difference between these subcritical and critical states. Here I have a very simple model. I assume a population of about 311 million people. That's about the size of the U.S. population. And I want to see what happens if 100 people repudiate the dollar. When I say repudiate the dollar, what I mean is they give up on the dollar. They lose confidence in the dollar. They take their dollars, they buy gold, they buy silver, they buy fine art, they buy land, they buy some other asset, and have no expectation of being able to get back into dollars anytime soon. In fact, they may think the dollar will cease to exist, and that's why they're trying to get out as fast as they can. A little bit like what's going on in Greece today, where people are worried about the end of the euro from a Greek perspective, and they're taking the euros out of the banking system because they don't want to be forcibly converted into something else. So in the first case, so I'm assuming 100 people repudiate the dollar. What happens? Well, in case one, the key parameter in this example is T. T is a threshold, a critical threshold. And all that means is how many other people have to do something before you react to it. It's kind of like people running out of a crowded theater. If you're in a theater and a few people run out, you might not do anything. But if 100 people got up and ran out, you might be right behind them. So in that example, your critical threshold would be somewhere between 2 and 100. It's different for everybody. Some people are more nervous than others, et cetera. But the point is, it's the number at which, if other people act, you're going to act also. You're going to run out of the theater behind them. So in case one, if 100 people repudiate the dollar, what happens? Well, what we see is that nothing happens because the critical threshold, the lowest critical threshold, is 500. That means that 500 people have to repudiate the dollar before the next 1,000 people repudiate it also, before you affect the behavior of anyone else, in other words. Well, we haven't had 500 people quit the dollar. We've only had 100, but since our first critical threshold was 500, we didn't hit the threshold and nothing happens. So that's like throwing a match in a forest, but the match just burns out and nothing catches fire and nothing else happens. There's an initial event, but nothing behind it, and the phenomena just dies out. Now have a look at case 2. I've changed a couple things. I've lowered that critical threshold, the first one, from 500 to 100. And I lowered the second critical threshold from, you'll see 10,000 on the left, but it's only 1,000 on the right. But those are the only two things I've changed. I've left everything else the same. But now ask yourself, what happens if 100 people quit the dollar? Well, as you see, when 100 people quit the dollar, you do hit the threshold for the next 1,000. And so now 1,000 people quit the dollar also. Well, if 1,000 people quit the dollar, you've now hit the threshold for 1 million. This will scare another 1 million people into quitting the dollar. If 1 million people quit the dollar, you're now past the threshold for the next 10 million, which is only 100,000 in my example. And so now 10 million people quit the dollar, and so on, all the way down the cascade until the entire population of over 300 million people loses confidence in the dollar. Now, the importance of this example, what I'm trying to illustrate, is that I got completely different outcomes. In the first case, nothing bad happened. In the second case, there was a 100% loss of confidence in the dollar. But I only had to change the preferences of about a few thousand people. In other words, we only changed the preferences of 3/100ths of 1% of the entire population. So the point is, very small changes in initial conditions can result in catastrophically different outcomes when you have a critical state system, which we do in capital markets. And so this should give the Fed some cause for concern because, as I say, they might think that they can print dollars forever without having any particular result. But in fact, they could become dangerously close to case 2 in my example, where they actually trigger that threshold and start an avalanche and destroy the dollar in the process. The next slide, we're going to move on to some specific cases. I'm going to go through these quickly because we'll have some time for questions later on. But what I'm showing here is that one of the keys to understanding the strength of the euro, and I know the euro has gone down about 10% in the last couple of weeks, so it's at the low end of the trading range of the last several years. But in fact, over the last 2 years, the euro has surprised a lot of people with its strength, and I think once this Greek situation settles down, you'll see it strengthening again. Well, what's going on there is that you have to understand the role of the U.S. and China. They're the other currencies I've illustrated, the dollar and the Chinese yuan. The U.S. wants a cheap dollar, and China wants either a cheap yuan or at least a yuan that's not getting stronger. Well, if those two countries want those two things, then the euro has to get stronger. It has to be it has to either maintain this value or get stronger, because that's the nature of currency wars. Not everybody can be weak at once. Each individual currency says, well, I want my currency to be weaker because I want to help my exports. But not everybody can be weak at once. So if some countries are going to be weak, some currencies are going to be weak, other currencies have to be strong. That's just the way it is. And so the world today is aligned in such a way that with the U.S. and China trying to weaken or put a lid on their currencies, the euro is strong and getting stronger. Again, it's traded down a little bit recently because of fears about Greece, but those fears will be over by June 17th once the Greeks have their elections. And I think from that point on, you'll see the new Greek government step up to the fiscal discipline treaty and agree to that, accept the so-called austerity measures. You'll see the ECB engage in a few rate cuts. That will restore confidence, and the euro will go back up. Then you'll probably see some QE3 later in the summer. So this really shows that you can't just think of currencies in pairs. You have to think of them in more complex relationships, and this really explains why the dollar is stronger. The next case I want to show just for a minute how Europe will solve its problems. The problem so far has been we need a convergence of unit labor costs. Germany is very, very productive, and its production costs are relatively low compared to high costs in Greece and other countries. And at least so far, Germany's been taking the position that they're going to maintain price stability in Germany, and 100% of the burden of adjustment has to fall on the periphery. That's my case one, where you see the periphery labor costs coming down a lot to meet German labor costs, which don't change at all. But very recently, Germany has agreed to accept some inflation in Germany. They're going to look at European-wide metrics rather than just German metrics. So what you're actually going to get is something like case 2 in this slide, where the periphery costs do have to be lowered, but German costs will come up a little bit with some mild inflation in Germany, and they'll meet somewhere in the middle. This is going to make it easier for the periphery to adjust. And I think you'll see some virtuous combination of kind of higher inflation in Germany, German technology, Chinese capital, and youth labor, which will enable the peripheral countries to lead an export and investment-driven expansion and actually get their economies in better shape. It'll take 4 or 5 years to play out, but once the plan becomes clear, that will restore confidence immediately. So I'm fairly bullish on the euro. I realize I'm a minority in that perspective, but I think Angela Merkel knows what she's doing, and I think the pieces are in place to kind of put Europe on a more sound footing. At least they have a plan. I like to say that a plan beats no plan, and the United States has no plan, but at least Europeans have one, and they are implementing it. Again, going to go through the next few slides quickly. I think the participants will be on the website, so they'll be able to go back and look at them. But recent developments in the currency wars, obviously the U.S. is engaged in financial warfare with Iran. We're seeing efforts by BRICS and others, including Nigeria, to move away from the U.S. dollar. And, of course, the possibility of war in the Middle East will bring this to a head. So these are small ways in which I think the dollar's role is being diminished around the world as other countries seek payment systems and ways of participating in the global economy that don't involve the dollar. The next slide, China's, I like to say, between a rock and a hard place. If they let their currency go up, appreciate against the dollar, which is what the U.S. wants, it's going to hurt their exports. But if they keep their currency the way it is, the U.S. will flood them with dollars. They have to print local currency to soak up the dollars. That's going to cause inflation in China. Both inflation and unemployment are politically destabilizing, so they seem to have no good choices. What they're doing in the short run is they're borrowing money and using it to encourage investment in various kinds of output factories, housing, rental units, white elephant projects, high-speed railroads, etc. That will keep your GDP going for a while as long as you have some unused borrowing capacity, but you're just creating problems for the future because a lot of this investment is wasted, misallocated, will not be productive, will not be able to pay back the debt. So I think China will power through 2012, but I look for them to have more of a hard landing in 2013. Next slide, I think the emerging markets economies all have some variation of the Chinese problem, which is if you want to peg the dollar, the Fed's going to keep printing and give you inflation. But if you want to let your currency appreciate, it's going to hurt your export competitiveness. So this is how the Fed really exports U.S. inflation around the world. And what we want is for all these currencies to get stronger against the dollar, which will bring the inflation back to the United States. And believe it or not, the Fed actually wants inflation because that's the solution to the U.S. debt problem. We can try to inflate our way out of it. It's not working so well so far, by the way. The Fed wants inflation, but they're actually not getting that much of it. So that just means they're probably going to have to print more. Look for the Australian dollar to maybe, it's been weak lately, but maybe do a little stronger than people expect, based partly on the fact that China's going to keep importing raw materials from places like Australia to keep their factories humming, even if it's excess capacity and stockpiling, they don't really need it. And there's also a lot of flight capital coming out of China. So there's a lot of money trying to get out of China into Australia to buy hard assets, such as vineyards, property, resorts, et cetera, mining interests, et cetera. because people in China know that that economy is going to come in for a hard landing, so they're trying to get into Australia so they can avoid that. Of course, that will help strengthen the Australian dollar a little bit. Japanese yen, I think, probably will get weaker because they need the exports. They don't really have anything else going for them. That runs contrary to the idea that the U.S. is going to try to cheapen the dollar against every major currency. But we may give Japan a little bit of an exception because they're still recovering from Fukushima and they probably need some help on the export side. The next slide is what I call the four horsemen of the dollar apocalypse, described in my book. It shows some outcomes for the dollar, all of them bad in different ways, but one of them multiple reserve currencies. I think that's unstable because there's no anchor. The other one is SDRs. I think that's where the global elites are pushing the international monetary system. The next time you have a crisis, it'll be too big for the Fed to paper over in dollars, but you may actually see the IMF try to paper it over with SDRs. So look for SDRs on the horizon as a future kind of world money that will be used to reliquefy the monetary system the next time we have a panic, because, as I say, it'll be too big for the Fed. They've already printed enough dollars. They're going to find that they can't print more, and so you'll have to go to the IMF for the SDRs. Third solution is a gold standard. I don't think this is anything that any central bank wants, but they may be forced to go to it if there's a complete loss of confidence in paper money. Plan B may just be to go back to some kind of gold standard. This is one reason that the U.S. is glad that it held on to the rest of its gold. We still have our 8,000 tons that we had in 1980 at the end of the 80s, and Europe actually has even more. And so Europe and the United States have the ability to kind of go back to some kind of gold standard. And the fourth outcome is chaos. I actually think this is the most likely. Through denial and wishful thinking and delay and kicking the can down the road, you may get the kind of sudden, unexpected loss of confidence in the dollar that I explained in that model of the of dynamic instability. And so that would be met with executive orders and probably some things that more closely resemble fascism, because governments will have to resort to what I call force majeure to stabilize the situation. If we do have to go back to a gold standard, the next few slides I'll go through quickly. It shows that the U.S., I like to say the U.S. is the Saudi Arabia of gold. We are a gold superpower. We have our over 8,000 tons compared to Germany, the next closest, which has 3,400 tons. But we have far and away the largest gold hoard in the world. Off to the right, you see that one bar with the 7,000 tons, but that's every other country in the world. There's no one country in that bar that has more than Russia at 600, and actually a lot of them have very little gold at all. So the U.S. is far and away the world champion when it comes to gold. Interestingly, in the next slide, if you take all the members of the Euro system who make up the Euro, the 17 countries that make up the Euro, and combine them, they actually have more gold than the United States. They have over 10,000 tons. So Europe is a player as well. If you take Europe as a whole, trying to back up the Euro, they have more gold than the United States does. But what it shows you is that Europe, the United States, and the IMF together have over 21,000 tons, which is two-thirds of all the official gold in the world. And, of course, Europe and the U.S. pretty much control the IMF. So we have the ability, I say we and our Western European allies and the IMF have the ability to go back on the gold standard. The pygmies, if you will, the gold weaklings are China, Russia, and some of the other countries you see here. Get into some implied prices of gold. If you were to go back to a gold standard, what would the price of gold have to be? Again, you want to avoid the blunder of 1925. In 1925, England went back to gold, but at the wrong price. They had printed too much paper money, as I explained, to go back at that price without reducing the paper money supply and incurring enormous deflation, which was very destructive. So if you're honest about how much paper money there is and how much gold there is, what price do you actually get? Well, you have to ask yourself a few questions. When you say money, what do you mean? Do you mean there are all these technical definitions? Do you mean M0, M1, M2? These are specific ways that the Fed measures money. I think M1 is a commonly accepted measure, but M2 is also a possibility, and M2 is a lot bigger than M1. And then the other thing you have to ask yourself is how much backing do you want? Do you want 100% backing? A lot of gold advocates favor that. But historically, countries have been able to operate on the gold standard with somewhere between 20 and 40% backing. So you have to answer all these questions before you can get to these implied prices. The math's not difficult, but the policy issues are pretty daunting. So what I'm showing here is that if you take M1, which is a smaller money supply, with 40% backing, the price of gold in that system would be about $2,500 an ounce. But if you take M1 with 100% backing, it gets up to $6,400 an ounce. And then over on the right, if you take M2, which means a lot more paper money, with 100% backing, that comes to $30,000 an ounce. Now, I'm not predicting $30,000 gold. I'm just showing that these are the kinds of prices that you'll get to when, as and if you go back to a gold standard, if you intend to avoid the highly deflationary blunder of 1925. On the next slide, we show the same thing, except here we do it on a worldwide basis. And the problem is when you do it worldwide, you include China, for example, you're bringing in a lot of paper money, but not very much gold. And so you're going to get higher implied prices because you've got to, spread that gold around among a much larger pool, a much larger money supply. Here, even the simple case, the M1 at 40% backing, that's $7,000 an ounce. And the M2 at 100% backing off to the right, that's $44,000 an ounce. So these are astronomical numbers, but they're not made up. They're not invented. This is very simply what you get when you compare paper to gold. And as I say, my kind of intermediate range forecast is for something around the $7,000 an ounce point, but you can't rule out higher prices than that. The next few slides show what happens to the stock market if you count the stock market not in dollars but in ounces of gold. You see it tracks pretty closely until around the year 2000. Around the year 2002, and then that's when the Fed's easy money policies under Greenspan and later Bernanke really kicked in, and gold took off. And since then, if you look at the blue line, that's the stock market, kind of going sideways, but some strength since 2009. But if you look at the gold line, that's the S&P denominated in gold. How much gold does it take to buy the S&P? In other words, that has collapsed, and so you could say that the real value of the stock market has actually crashed once you think about it in gold. Same slide is the same thing, but taking out financials, and here you get an even wider spread. The slide after that is the same thing, but take out food and energy, deflate the S&P index ex financials by food and energy index, and again you'll see in every one of these cases that in nominal dollars, the stock market's been going up lately, but in real terms, whether it's measured in food and energy or measured in gold, the stock market has either been crashing or going sideways. And then finally, the last slide shows Berkshire Hathaway stock priced in units of gold. And around 2000, it took 280 ounces of gold to buy one share of Berkshire Hathaway. Today, it takes about 70 ounces of gold to buy one share of Berkshire Hathaway. So, again, if you think of Berkshire Hathaway measured in real money, which is gold, that stock has gone down 75% in the last 10 years. So it's just a different way to think about the nominal valuations of the stock market. Once you start thinking about it in gold, you get very different results. Again, next slide, I do look for chaos ahead, and this is described in my book, Currency Wars, The Making of the Next Global Crisis, and I hope the listeners and participants in the webinar have the opportunity to purchase it and read it. Again, it's been great going through this presentation, but this is all explained at much greater length, much more detail, and hopefully an interesting read in the book itself. So I hope the participants do get to buy it, and I thank you very much.
And thank you. Now we will take questions from our audience.
Today, and we'll likely go past our 3 o'clock time frame a little bit, but we may not be able to deal with all the questions. So a couple that I'll just get started with. Jim, lately gold hasn't been assuming its role as a safe haven, but rather the U.S. dollar has been strengthening. Why do you think that has been happening?
Well, obviously there's a so-called flight to quality aimed at the U.S. dollar and U.S. Treasury securities in particular. It's not so much the dollar. It's people buying U.S. Treasury securities, but to do that, of course, you have to buy dollars. So if you have euros or any other currency for that matter, and you want to buy treasuries, first you have to sell the currency for dollars spot, and then use the dollars to buy the treasury. So what it really is a flight to U.S. Treasuries. Now, so the question is, why is that? You have to understand that a lot of the people in this so-called flight to quality are people who are never going to buy gold. They're institutions. They're money market funds. Money market funds that invest in any kind of European commercial paper or euro-denominated commercial paper want to get out and get into dollars. They're corporate treasurers. Corporations have trillions of dollars of cash on their balance sheet. If some of that's in euros, and it certainly is, whether it's accounts receivable or just deposits in European banks, they may want to get out of euros, get into dollars. You have banks that lend to other banks, and those banks are pulling out their euro deposits, and some of them are switching them to dollars. But the problem with all these institutions that are running into dollars, whether it be money market funds, corporations, or banks, they're never going to buy gold. They either legally can't, or they're institutionally constrained. A money market fund can't buy gold. A typical corporate treasurer who bought gold would probably get fired. And so it's not a pure – the markets are what they are. They're telling us something, but I wouldn't read much into it in terms of the dollar versus gold, because it's important to understand that the people doing the buying are never going to buy gold because they're institutionally constrained. So I think the bullish case for gold is very much intact, but in some ways this will make the gold pop even stronger, because people are now running out of euros and running out of other currencies, running out of Australian dollars and others to get into U.S. dollars, U.S. treasuries. But at some point that bubble will pop, and then that's when there really will be, I would say, panic buying of gold. So I wouldn't really expect to see much gold purchasing coming from what's going on right now with the fears in Europe, because the people doing the buying cannot buy gold and never will.
Do you think that will change? There's been some discussion of gold becoming a Tier 1 asset instead of a Tier 3 asset, and if that's introduced, presumably that would increase the demand for gold and change those kind of attitudes.
That will change over time, but those proposals really coming out of the Basel III, they're going to be phased in over a 5-year period. So I think at the margin, will it add a little buying to gold? I think yes, and it will help support the price. But that's not a here and now phenomenon. That's something that I think will play out more kind of around 2017. But we'll probably see a lot of action in gold between now and 2017 that has nothing to do with Tier 3 assets or Tier 1 assets.
Some people think that the U.S. financial system has already sort of crossed the Rubicon. In your opinion, is there still time to fix it, or in terms of anything, or do you feel like you just mentioned that we're destined for chaos?
I don't think we're destined for chaos. I think chaos is the most likely outcome, but I don't think it's inevitable. I don't think it's too late. But as I say in my book, it gets later every day. I guess I'm not optimistic that policymakers will make the right choices, but if you ask me whether it's possible, I would say yes, it's possible. And my example there to prove that point would really be the one mentioned in the presentation, Paul Volcker and Ronald Reagan in 1980. I mean, you have to go back to January 1980. Remember, the election that year wasn't until November 1980. Ronald Reagan wasn't actually sworn in until January 1981. Paul Volcker was the chairman of the Fed at the time, but he was waging a fairly lonely battle. January 1980 was the month when gold went over $800 an ounce. And just briefly, of course, that seems low by today's standards, but that was 30 years ago. By the standards of the time, that would have been the equivalent of something like over $3,000 an ounce today. So the point being, things looked pretty bleak then. I mean, I was living in New York, and you couldn't go out to lunch without seeing a chain snatching. You had to walk over bodies to get to the subway. The city had just come out of near bankruptcy. We had the Jimmy Carter malaise. Energy prices had quadrupled. There were fears that then the Arabs were going to dump the dollar and buy gold, and some of them were. So things were pretty bleak back then, and it could have got worse, but it didn't. As I say, Paul Volcker, Ronald Reagan turned it around. So the problem is at that time the solution was high interest rates and low taxes. Today we have low interest rates and high taxes, so we have exactly the wrong medicine. So if you ask me whether I'm optimistic the policymakers are going to find a way out of it, the answer is no. But if you ask me whether it's possible, I would say yes, it's possible, but it's going to require some leadership and some correct understanding. A lot of the problems I see are the fact that people don't know how to diagnose the problem. If you don't understand the problem, you're never going to get the solution.
Right. In your presentation elsewhere, you talk about the gold the U.S. holds in Fort Knox, and there's been a lot of speculation of whether it's there, and people like Ron Paul have called for an audit, which seems to have been excessively resisted. Do you think there's any chance that the gold actually isn't there?
Well, when you say is there any chance, I suppose anything's possible. I have seen no information whatsoever, no credible information that says the gold is not there, and I have seen credible information that says the gold is there. So I take it that the gold is there. I base my analysis on that. If somebody breaks in and opens the vault and it's all empty, then I'll change my view. But my best information right now is that the gold is exactly where they say it is. Of course, it's not all in Fort Knox. It's half in Fort Knox and half at West Point. There's another gold depository at West Point again, but the information is the gold is there. But the typical gold advocate, they base the fact that the gold's not there on an inference, and they derive the inference from the fact that nobody will agree to an audit. And they say, well, gee, what's wrong? I mean, obviously you have something to hide if you won't do an audit, and if you're saying no to an audit, the gold must not be there. But that's exactly the flawed logic that was used to get us into the Iraq War. Remember, we kept saying to Saddam, let us come in and inspect, and if you don't have any weapons of mass destruction, then you don't have anything to worry about. And Saddam Hussein would not let the inspectors in. So the inference was, well, if he won't let us in, he must have weapons of mass destruction. But, of course, he didn't. He just had other reasons, and it was the failure to understand those other reasons that was the intelligence failure in that case and led to a misguided war. Now, as applied to gold, people saying, they won't let them audit it, so the gold must not be there. That could be a highly flawed inference. My inference is different. There are very good reasons not to do the audit, namely the fact that since 1973, gold has not been part of the international monetary system. Of course, Nixon took the U.S. dollar off gold in 1971, but it wasn't until 1973 that the IMF officially demonetized gold, and ever since then, it is not an official country reserve for IMF purposes and has had no role in the international financial system. And we've all heard all the disparagement of gold. Warren Buffett says it's just an inert cube that has no yield, and Ben Bernanke says it's just a tradition. Kind of like, we got it, it's there, but it's not really important in any way. So gold is constantly disparaged. Well, the problem is if some official ordered an audit of gold, implicitly they would be saying gold is important. In other words, it would cut against all the propaganda that gold is unimportant. If it's unimportant, you wouldn't have to audit it. If you're going to audit it, it must be important. So one of the reasons to resist the audit is not because the gold is missing, but because it gives gold more credit than the central bankers would like to give it. So I think that's really the reason. It's got a political motivation. Beyond that, the other thing is if you did the audit, it wouldn't be the end of it. Let's say you did an audit and all the gold was there and it was the right fineness and the right weight and the bars all had serial numbers and you had a manifest and everything was all good to go and said, it's all there. Well, that would immediately open Pandora's box for additional questions. You would say, okay, the gold's there, but is it leased? Is it hypothecated? Who is it leased to? And what quantity? For what term? In other words, you would open up Pandora's box. You'd open up the door to a whole bunch of other questions that they don't want to answer. And I would say the gold almost certainly is there, but that doesn't mean it's not leased. It could be, people have this sense that if you lease the gold, somebody backs up a truck and takes it away, and that's not true at all. You can lease the gold, leave it in the vault, but just do everything on paper. So I think there are two reasons for not doing the audit. One, it gives gold too much credit, more than central bankers would like. And two, it opens the door to a lot of questions. And when you think about it that way, you can understand why officials won't do the audit even if the gold is there.
recently the U.S. dollar has been strengthening. So the government will be forced to intervene soon to weaken it, or will it weaken by itself?
You're right. Of course, the whole premise of currency wars and a lot of the thesis is that the White House, the Treasury, and the Fed want a weak dollar. Well, they certainly do want a weak dollar. The problem is they're not getting it. And so what's the policy implication of that? Well, the policy implication is try harder. My inference is that this is going to basically be the green light for QE3 or some version of QE3, which last winter I had it kind of around now, I would say in the June time frame, but now I've got it more in the August fall time frame based on a couple developments. One is the economy showed a little bit of strength in the first half. I think that strength is fading fast. I think you'll see tomorrow's employment report, maybe a bit of a shocker. Who knows? We'll see how that comes out. But a lot of the recent data, PMI, industrial output, initial claims has been getting worse, and so there's every reason to believe that 2012 is a replay of 2010, 2011, which is the economy starts out the year strong but then weakens kind of in mid-year, and then this is when as I said, the Fed has announced these various programs in the past. So I think the fact, you're right, the dollar is getting stronger. The Treasury and the White House want it to be weaker, and so therefore I think you'll see more easing in an effort to weaken the dollar. That's been the play all along. But the other reason I think the Fed is holding off is because the next easing I think we'll see will really come from Europe. I think there were a couple of ECB euro rate cuts in the cards, and the Fed is willing to let the Europeans go first, let them do their rate cuts maybe in late June, early July after the Greek elections, and then maybe we'll see some quantitative easing in August, September timeframe. So my answer is if you can't get a weak dollar, you just have to try harder.
And maybe one final question I think that's on many people's mind, and there's a lot of speculation about it. Do you think the euro can hold together in its present form?
Yes, I'm very bullish on the euro. I think the euro will hold together. No members will quit. No members will be kicked out. New members will be added over time. I understand the euro is off about 10% or about 5% in the last couple of weeks. It's at the low end of a long-term trading range. So I mean, obviously you see that day-to-day action, and the causes for that are pretty obvious, having to do with the problems not only in Greece but now spreading to Spain. But I think what you'll see, actually some rumors of it today, is that Europe will do what it takes to shore up the system, whether it's IMF assistance for Spain or a European Deposit Insurance Fund, sort of like our FDIC, or some kind of joint banking regulation. There are a lot of things they can do. They haven't used up all the bullets. And then beyond that, you've got further rate cuts from the ECB. But nobody wants to do anything until after the Greek elections. We're in a very dangerous period right now because you have to hold Greece's feet to the fire, and you have to send a message to the Greek people that you need to elect parties and politicians who are going to adhere to the agreements, the fiscal stability agreements reached with the rest of Europe. And so if you do things now, such as cut rates or do a bailout fund or something now, it's going to let the Greeks off the hook without them really having to sacrifice very much. So nobody wants to do anything before June 17th because you want to hold the Greeks' feet to the fire. On the other hand, it's a very dangerous world, and 3 weeks is a long time. So I do think it'll be a very volatile and maybe even somewhat negative couple of weeks. I think you'll see some announcements coming out of Greece. They have to do something. Tim Geithner is meeting this afternoon with the Deputy Prime Minister of Spain. His international counterpart, number 2 person at Treasury, Lael Brainerd, is over in Europe right now. She's meeting with the Spanish finance minister. So there's a lot going on behind the scenes. The U.S. is very concerned. Of course, we're in an election year, and the last thing President Obama needs is for Europe to blow up between now and November, because if it does, the U.S. will be right behind. And so they're going to do whatever it takes to patch this up and keep it going. I'm not saying things aren't bad. Don't get me wrong. The countries are, bordering on insolvency. These bonds are a mess. The banks are insolvent. They have very, very serious problems in Europe. But they don't have to solve them all at once. They just have to get on the right path in a credible way. And if they do that, the markets will give them credit and give them time to implement the program. And there's a lot of brinksmanship going on between Germany and the periphery, and we'll see who blinks first. But at the end of the day, they'll do what they have to do. The euro will hold together. To me, the whole European thing is a sideshow. The really serious issue in the world today is China.
Well, great. Thank you, Jim. And thanks again. It was a terrific presentation and very educational for everyone, I'm sure.
Thank you.
We appreciate everyone taking the time to join us this afternoon. There'll be a replay available of the presentation, by Tuesday, June 5th. So for more information on Jim's book, you can go to our website, bmgbullion.com events, which will have more information on Jim's book as well as a replay of this webinar. Once again, thanks everyone for joining us, and thanks again, Jim.
Thank you.
This concludes the live broadcast of Currency Wars and Capital Markets No Escape, presented by Bullion Management Group, Incorporated. The replay of this webinar will be available at www.bmgbullion.com on June 5th, 2012.